Rajesh Sethi's bank FD matured, he took out that money and invested in P2P, that is peer-to-peer lending platform. The 16% return on investment in the lending platform was higher than that of any other investment scheme. For 3 months, everything went well. But from the 4th month, the payment delays and defaults of the borrowers started to play a spoilsport on the returns. That means not only the desire to earn a return of 16% eventually became difficult, but also it became all the more difficult to get back the principal amount. How your returns can get stuck on P2P platforms? Quick loan is available on P2P platforms. These platforms promise high returns to investors and raise funds from them. This fund is further passed on as loans to those people who are unable to get loans from banks and financial institutions. People with low credit score take loans on such platform. The profile of the borrower is created on every P2P platform. The borrowers are graded on the basis of their ability to repay the loan. The borrower whose profile is weak has to pay more interest on the loan. People with some amount of cash with them, in the greed of higher returns, choose candidates with low credit score who are most prone to default their loans. Be cautious. Jitendra Nehra, founder Superfine Microfinance, says that those investing in these platforms need to be very cautious. Do not hand over your hard-earned money without looking at the company's reputation. Check the business model of these platforms. See their track record. How many loans are being sanctioned, and more importantly, what is the track record of loan repayment on their platform. Check the default rate. Understand what are the options available with the company to return your investment if the loan defaults. Jitendra Nehra explains from his calculation that small ticket size loans can give 528 times returns in 12 years. But a lot depends on the policies of the lending platform. What does RBI say? According to the RBI guidelines, an investor cannot deposit more than 50 lakh rupees in these companies. Those depositing more than 10 lakh rupees have to produce a certificate of their net worth signed by a chartered accountant. The P2P platform divides the money collected from an individual among different borrowers to reduce the risk on the investment. The P2P platform claims that their default rate does not go above 2 to 3%, but the reality is something else. The one who does not get loan from anywhere else reaches here. In the event of non-repayment of loan, the borrower is pressurized. The borrowers often look somewhere else to arrange the repayment, but many times borrowers disappear after the loan is sanctioned. Eventually, this loan has to be written off. The P2P platform is regulated by RBI, and according to the guidelines of Central Bank, the recovery calls can also be made, and these companies have option of going to court for recovery. Money9 suggests P2P platform earns through levying commission and registration fees of the creditors and debtors. In case of loan default, the company keeps its share of money invested safe as buffer money. But those investors lose money in these platforms who invest with the greed to earn high returns. Along with the returns, the principal amount also remains at risk. In such a situation, it is better to avoid investments in these platforms.